Today's episode of the Watson Weekly podcast is sponsored by Commerce Tools.
The world of commerce is fast-paced and constantly changing. Commerce Tools, the global leader in commerce and creator of the powerfully composable mock architecture, enables commerce leaders to turn possibilities into reality. Commerce Tools helps businesses go from underperforming to overachieving, and from keeping up to setting the pace, all at a lower total cost. Go to commercetools.com to learn how to get started.
It's July 10th, 2023, and this is the Watson Weekly, your essential e-commerce digest. For today's episode, we have something very special for our 100th episode, an interview with e-commerce industry experts and fellow Watsonians, Victor Castro and Hendrik Laubscher. In this episode, we talk about some of the most important things going on in e-commerce from an investor point of view, as well as digging into both Amazon and Shopify. That's right, friends. We started this podcast about 2 years ago today, and we're still going strong. Thanks so much again for your support. All right, everyone. Welcome to the 100th episode of the Watson Weekly. This is a milestone podcast with two very good friends of mine that we have here on the call. One is Hendrik Laubscher. Hendrik has been in e-commerce for over 15 years with focus in particular on marketplaces and cross-border. He offers a lot of boutique consulting services to brands of all sizes, works with startups, particularly in fast-growing sectors like live stream shopping, consumer to manufacturer, meaning like some of the biggest and most innovative marketplaces and more. Victor, and it's interesting, both Victor and Hendrik I met over 10 years ago now, which gives you some idea how old we are in e-commerce. Victor has been with a number of brands, including, and I like to say that Victor always likes to choose the most difficult categories in e-commerce. Otherwise, how could you go from selling teddy bears to wine to what all? Give us your intro, Victor.
To menopausal supplements, to now infant formula right in time for a national shortage. Not by choice. I always try to find easy jobs, and I think, or rather, I always think they're easy when I take them. So maybe it goes to be being naive about different verticals. But I've enjoyed my time dealing with different challenges across different brands. I think I'll be bored otherwise, right?
Right. And look, e-commerce, there's no easy businesses.
I thought that's what the E stood for.
Right. The E in e-commerce is easy. I don't know. I don't even know what it stands for anymore. So we have a number of topics that we're going to talk about today, and we're going to hop skip through a few different things. One is kind of fundraising, venture capital, economy. Next is we'll talk about Amazon, what's going on with them right now, 1 year after Andy Jassy has taken over, what's happening there, and then we'll probably end up on Shopify, and then kind of more retail more broadly. Shopify is always an interesting topic just because they're used by so many people and everyone has a lot of different opinions on them. But wanted to take a quick moment to talk about just the Watson Weekly in general. I know both of you guys have been contributors for ideas for the podcast over the time, giving me feedback as we change formats of it different time. Why don't you tell me a little bit about, first of all, do you even listen to it? By the way, you're supposed to lie. Second, what makes it different from other podcasts from your point of view?
So, Rick, I'll take the first stab at it. So I do listen to this, and no, I'm not lying. Two, I primarily listen to Rick's stories and opinions while I walk my dog in Cape Town, South Africa. I find it therapeutic that Rick's voice tells me all about the most interesting news that's relevant for me. And I think the reason it's different than any of the other podcasts is that in general, the e-commerce podcasts that I've been on or the ones that I listen to are long, and you kind of sometimes get lost in some rabbit hole that the presenters are on. Whereas with yours, the Watson Weekly, especially, as everybody wants to be a Watsonian, it's just a case of it's short, it's sharp, and it's to the point. And then it's also it's fair. I know some companies might disagree with that comment that I just made, but I find your coverage and your stories to be really fair in the sense that you provide all sides of the story so that there's decent quality content available for people to listen. Because let's be honest, there's too much information. And as an e-commerce exec, you need to know exactly what's going on because it can impact your business, especially like somebody like Victor, who is always looking for like the advantage.
Yeah, I listen to it, not as consistently, maybe, only because I don't listen to podcasts all that often. So I binge, let's say. But I like that it is concise. It doesn't drone on, and two, I like that you don't tell us what to think, right? So a fairly balanced presentation of the facts, and then sort of gets a nice opportunity to think through. I mean, I like it a lot. Like I tell you all the time, I really appreciate your LinkedIn posts, like the most thought-provoking posts I find. And this is a little bit of the same in a different format, in a way that you can expand a little more than it's hard sometimes in written form to really present it. So I like the conciseness. I mean, I think that you give me the facts. I really appreciate, especially when you're doing some of your earning reports. I don't have time. And like, to me, that's something that you're able to pull that key 2, 3, 4 points out of the earning report. I do find that they tie into macro stuff very well, right? Like you can see it in the earnings report, and you're like, yeah, they're basically living what is coming to the rest of us. So it's a nice window into like things to keep an eye on. Like example of that is like you've been doing the earnings reports for like the big carriers for a while, and we have been seeing the changes right in the earnings report, and it's landing into what you see in other places of the industry. Right, this is where Shopify now was 3 quarters, 4 quarters behind, and then getting rid of their warehouses for the same reasons, really, right? And I think you see the consolidation in the 3PL market space. So I think that when you're doing those reviews, you're giving us a little bit of a window of what's coming farther down market, right? If you're not an enterprise at the level of a carrier, to me, it's valuable. I feel like I'm staying a couple of quarters ahead of what other people are paying attention to. So yeah.
Yeah, no, I think that's good. I mean, obviously LinkedIn only gives you so much to write about, and it's hard to get everything on LinkedIn because it's so noisy. I mean, even if you want to follow someone, it's quite difficult to follow someone. And so if you want to hear things, and I can give it better treatment on the podcast. Wanted to jump into venture capital, and I'm just going to go straight for the jugular here. AI. Do any VCs know what the hell they're doing here? And how is this not going to be a repeat of crypto and blockchain and Amazon aggregators times 10 because everyone's piling into the same idea?
I'll say that listen, maybe I'm not paying attention. I think that the market dynamic has changed. So yes, conceptually it's the same, but they're not falling for the same thing again, right? There's a lot of people on the sideline. So it's not as many. It's not Web3 crypto where everybody got in and it failed. Also, the grift is not as bad, right? So Web3 crypto grift was crazy. The grift on the AI is a little more transparent. Now, I'll tell you, like, I think that Web3 and crypto sort of had a little bit of like that technical, quote unquote, difficulty that was sort of shielding people. And so it was a little more sort of difficult for people to grasp. But I think AI is a little more accessible, right? So everybody's playing with it. Everybody use the concept. Like, I don't know. I think that it's not as bad. I do think that money's not cheap anymore. And so they're not treating it like that. And they're not just throwing it around as much.
So having spent, I'd say, a fair part of the month of June on AI, I think let's get the elephant out the room. And the elephant out the room is that AI is not going to come into your front door and replace you as a human. I think that's really important because certain very well-known investors has written that, there are different forms of, AI, people that don't like it. I don't have a horse in the race. But I'll tell you, I think what's really important is, and I think a story that I think has gone underreported by the sector, the tech sector, is what happened at Reddit. And Reddit essentially said that if you are building apps or businesses from our APIs, we actually want you to pay for it. I believe that with AI, the challenge isn't about the technology. I think the technology will basically be built by everybody and anybody because it will become democratized. I think it's going to be access to basically proprietary data sets that'll give you specific information for specific sectors. While we just did this, I just saw Databricks just spent like half a fortune on a business for this specific reason. So let's also be honest here, Rick. And I think it's a really important topic that Victor has kind of just mentioned, but I think it's also worth mentioning again, is that there is grifting, without a doubt. But I think the various differences between this market for AI, which is frothy, let's just say it, is that there is actually things being done in front of our eyes where you just like think, wow. Yes, everybody finds ChatGPT hell of annoying. It's on every LinkedIn feed and on every blog post, but it's moved us forward one step in automation. And then lastly, let's just realize once again that humans will be needed to make decisions because there is only so much data that can be used currently for training of these models.
So what I'm hearing out of this is there's obviously some value. A lot of improvements are going to be made. It's not going to replace humans. And there's going to be a huge value in these specialized data sets. The question is like, will the value of those specialized data sets only accrue to the big networks like Google, Meta, Apple? Or is there a chance for smaller providers to have a role in an area where the tools are owned by all these big providers? Because, look, you're going to have to train your data sets on Microsoft's cloud or Google's cloud or Amazon's cloud. There are only going to be so many places, maybe Snowflake, potentially. But there's not going to be a fifth, sixth, seventh provider here. So is the App Store really kind of more like a data-based app store where you can plug in proprietary data sets that you now have to license from these various providers?
Rick, what you've just asked is, I think, exactly what has kind of gotten lost in the details. And that fellow that sits in Silicon Valley called Mark Zuckerberg has realized very quickly that, and I'm not being derogatory, I think it's actually a genius move what he's done. Is he's realized that there's either one of two ways that this can go. It either will stay open sourced and it'll become a licensing nightmare, which will have those awful people coming after startups because they don't own this IP. Or what he's trying to do with Meta and saying, you know what, we are going to roll this out, make it available for everybody. We just want to generate money based on the usage of the models in whatever way. I think it does have a significant advantage for the larger businesses, the ones that you mentioned, the Apples, the Amazons. It's simple in the sense that you need development and talent, and you need, the access to the right data sets. And sadly, that's inside the large companies who have all of these glorious things in abundance.
What do you think, Victor? Like, where's the money to be made? Where is the opportunity for independent software developers? I'm looking at like the Shopify. Like, where's the Shopify App Store opportunity in this market?
I think the opportunity here is in building unique niche data sets that nobody can replicate, right? And so like what the opportunity is to build the tool that attracts the audience that will give you that data. So, there's a value exchange that you have to do, right? Like look at the news, right? Reddit, crap tons of data, lots and lots of data for all kinds of communities. And that is the data that will, that is the personally, and you've heard me say before, I think are terrible decisions happening at the management side of Reddit. But the driver is correct. The driver is, we have all this invaluable niche data that can train and is being used for free by others to train AI models. I mean, listen.
Right. They have to charge for it at some point.
Right. But, I think that what it shows is their lack of not even vision, because it's not about like actually having visibility into the future. But I think that honestly, they just didn't really build the tooling and systems to be able to do this properly. Right? They should have spent the last 5 years building improved tooling internally for community management, and then two, the right tooling for managing accessibility to this API. Basically, what they're saying to me is, we're gonna kick everybody out because we have no way to control access to our API in a meaningful way that we can monetize logically and sensibly. Right. So instead, we're gonna just kick everybody out because we're gonna charge everybody a fee for the API access. So that it goes to show you that management needs to look at themselves for that failure. And I see that if they continue to do what they're doing, they will actually lose the source of that data. Think about how many communities are there with free content, but more importantly, they're moderated for free. How much money does it cost in Facebook? How much money does it cost Elon? Look what Elon did. How much money does it take to moderate communities of this size? And Reddit is getting it for free. And that is what actually feeds the model, because all of a sudden, if those communities go unmoderated, or the moderators go away and they stop using the tools they use to moderate the content and the quality of the content, then the quality of data goes down. And if that quality of data goes down, it's a lot less valuable to train an AI model. So I think they're missing the forest for the trees here. But to me, the opportunity is that. The opportunity is, can you build out a tool, an app, a game that exchanges entertainment, information, content for data on the other side that is very dedicated to a specific topic or a specific niche? And you can then sell that as a training engine for an AI model to use elsewhere. And I think that in terms of e-com, right? I mean, this is the kind of stuff that I think that it will be interesting space for some of the people who have been used to monetizing content and blogs, and a lot of it was typically affiliate links. And I actually think that there is an opportunity for them to monetize behavioral data through AI models, rather than having to leverage clicks to conversions and getting a cut. Where, if you're a large blog, like take something like the Wirecutter, right? New York Times own Wirecutter, great content. They see a lot of behavior. They see a lot of behavior data by vertical. That stuff is stuff they can leverage the data of the behavior as opposed to just trying to get the money from the clicks. So
No, it's interesting. Yeah, so AI is obviously going to be a huge trend, I think, in venture capital. From a valuation point of view, it seems like we're coming back to earth. I mean, I remember advising companies 2 years ago. If you were valuing a direct-to-consumer business, middle of the road, 3 times revenue. It was a middle of the road valuation with some of these direct-to-consumer, with much higher upside for the crazy ones, right? But I'm talking like not the crazy ones even. And then SaaS businesses, between 8 and 12 times ARR or annual recurring revenues, somewhere in that range. Now in 2023, what do we have? We have no IPOs. We're just starting to have a couple of IPOs appear for later this year. And then we also have especially in the past 3-6 months, we have no acquisitions. So even the private markets aren't picking off a lot of these companies. So I've seen, I think, ARR multiples that used to be, that I would think, even for not fast-growing companies that I thought would be like 6 times ARR, now are in the 1.5 times ARR range. So things are, I don't know, consistently I'm finding things like 25% of what they used to be in the good times. And maybe that's a good thing or not. What are you seeing out there, Victor?
Well, I think it's interesting. On the DTC side, yes, valuations were very, very high. I mean, people were throwing a lot of money early just on growth rates, and never mind even revenue numbers, right? It was just like, oh, you're growing at 500%. Here's a boatload of money.
Right.
But I think that it is interesting because one of the things that, listen, I'm a DTC guy. I do believe in the thesis of, being able to scale fast and grow, but you do have to have those unit economics in place, right? And there was a lot of ignoring the unit economics and thinking that you could potentially eventually lower your costs enough. But the thing that people miss, and I think that really the big light bulb went off with the iOS change, the ballooning, and the problems that Facebook had where everybody was relying on these low CACs, was that this was always true, but people forgot because it had been so sort of...
so cheap.
It had not just cheap, but consistent, right? And so what happens is that when you're looking at a DTC business early on, the fixed cost is fairly relatively low, right? You invest one time in R&D, you get supply chain from outside, whatever it is, and your variable cost is the cost of acquisition, the marketing, right, and the fulfillment. And people consider like the stable cost of acquisition cost you were getting as sort of like they almost thought it was fixed, put a bunch of money behind it, and then when the reality came that those costs actually scale as you scale and they get worse, the math on the original thesis fell apart. And I think that after that realization, when they're looking at businesses now, I think there's a real challenge because they're like, okay, you're growing at a good clip, but for you to continue that growth, you're going to have to continue to increase your CAC at 10, 15, 20%. And if your unit economics are not getting any better, there's no real economic scale. And so I think that you'll see that early stage is actually in good shape. So what I'm seeing is pre-seed, seed, it actually is just as competitive in terms of like fundraising. Everybody wants to get in, no problem. I think
so this is news for all you startups out here that don't let the lack of capital or the cost of capital, everything that's happening. A lot of this happening is like Series C, D, and
even B.
Anyone who's trying to exit.
Yeah, B plus, right? Anybody that maybe took a smaller B and is trying to do a B plus, I think is finding that time challenging. Or honestly, they just don't have a good business. I think that the majority of them are finding themselves at B and then trying to sell a B plus or a C under the same economics they had at A and C that are not getting the support anymore because they don't see what's the exit, right? People were racing at 5x and revenues, and now nobody sees the end of that tunnel. There's nobody else holding a bag paying 9x in 2 years.
Yeah. What have you seen, Hendrik? I know you talk to a lot of startup founders as well.
So one, I believe the good investors, the guys who write the guys and the girls, let me just, before I get into trouble, some of them stopped writing checks in the chaos. I remember seeing during the COVID stories, I remember seeing diligence being done in like 24 hours. So we were always going to have a reckoning. I think Victor's point about pre-seed, seed, Series A, I totally agree with him. I see the same. I see the trouble starting at like Series C, where you don't have product market fit and you also are unable to scale because you either don't have enough product in the market or you are not creating enough product to get consumers to be buying from you, whether it's whatever the replenishment cycle is for a specific category. Two, I think the one thing that neither of you have mentioned is that there's this thing called SoftBank. SoftBank stopped writing insane checks. And those insane checks essentially were fueling the Series B, C, D ranges where it doesn't make sense. We've seen them exiting and closing down businesses. And, we saw Master Son early in the week say that, he's going back into it all aggressively. I keep an eye on a group of 15 venture funds. Some of them are on Sandy Road. Some of them are based in New York. And a lot of them are still writing checks for startups, but it's no longer 5 or 6 TechCrunch articles a month or a week. It's now 1 or 2. And there's a lot more diligence being done in terms of the team, in terms of the opportunity, but also making sure that there's an actual 10x opportunity.
Yeah. So more diligence on the business model, more diligence on the team, which had kind of stopped.
Yeah, there's less FOMO, right? There used to be FOMO from people is like, oh, you already have 2 term sheets? Doesn't matter. I
got to get in.
Sheet. That's right. And they didn't even know who the founder was, right? It's like, oh, those 2 are already in. Here is a similar number at slightly better terms, ship it, right? And after they got it, they're like, what did we buy? Okay, great. And yeah, I think that has stopped. But I'll tell you on the business side, one thing that I will tell you, just I'm hearing a lot and seeing it, is the due diligence on the business side. Okay, and it is incredibly strong. The level of questions that people are asking tells me that it was not an accident, or no, I don't rephrase that actually. That it was not that they were making mistakes before. They were purposefully not asking the questions, right? It's not like they didn't understand the business, because it was like people were not asking.
Throwing money down a hole that they thought would eventually produce money on the other end.
They actually know all the metrics and all the levers that run a DTC business successfully, but I had not heard them ask those questions at any funding level until in the last like 6-9 months, or maybe 9 to 12 months now. Before, it was like, what's your GMV? How many customers do you have? What's your growth rate? Here's the money. Now it's like, what is your CAC today? What is your CAC going to be in the next 2 quarters? Why is it going to be lower? How is that going to change your AOV and your LTV? And they're doing the math on like payback on your CAC. And they're like, those are great questions, and I'm happy to answer them, right? Those are amazing. But they weren't asking those questions 9 months ago.
I think the other thing that I'm also seeing, Rick, which is important, is that the real world, retail has retail valuations and funding sizing and those connections are being made. We're not talking that we're creating new companies in new sectors and, the world is a great place. We're actually talking what's really happening right now, which for me is a great thing to see.
So venture capital, it's more challenging to raise money.
Mm-hmm.
And however, investors are still taking bets on early stage companies that you aren't supposed to have a lot of traction pre-seed. And that's okay. As long as you have a story and as long as you have a great team and you show some numbers about what you're doing and why you think you have a plausible case to make money, you could still raise seed right now. But without even some idea, personally, I don't think you can raise a seed round with at least some idea of your unit economics and at least some minor proof, at least, that why you think it's going to play out this way.
100%. That's it. I think that there's plenty, actually, I think, of people looking to fund earlier stage because they don't have those later stages to allocate to. I mean, I think that I've been hearing, anecdotally, but I've been hearing of, VC funds returning funds to their LPs. Honestly, and I think the play is because, one, they don't have a place to allocate them, but B, it makes the returns look better, right? And they have penalties for those. And so there is money sitting out, but if you have, on the DTC side, if you have a good unit economics and you have at least some proof of your cost of acquisition to some extent, and the reason is that most marketing channels on the DTC side are scalable, right? The channel is scalable. So what you really have to do is prove out that you're acquiring, to Hendrik's point, go through some acquisition, prove out your acquisition costs, and then 2, prove out your cohort analysis, that they have the right LTV to justify your CACs. And I think you can go with that and do raise some cash. I mean, it's not going to be the crazy amounts that people were raising before, but people were taking everything. They were taking sort of like huge runways. And you're not going to get a 24-month runway anymore. Nobody's giving you that at seed, right? But can you get enough to scale from year 1 to year 2, go from, say, sub to $5 million in revenue to go into like the 20s? Sure, that's doable.
Yep.
No, it makes sense. So let me move on from VC and go into Amazon, because I think Amazon is at an interesting point in its history. I'm just going to go out on a limb here. Like Jeff Bezos used to worry about day 2. Are we becoming an innovative company? The day 2 horse has left the barn 5 years ago, in my opinion. We are not dealing with the Amazon that we all knew 10 years ago, where the consumer is first and we're willing to lose money at all costs, provide that magic experience. We're not willing to put ads in front of the consumer. All of that stuff is just gone. We're really at the point where Jeff is on his yacht. He finally got it out of the port. He's living life. The worse Jassy does, the smarter he looks. Amazon obviously overinvested in fulfillment infrastructure at the peak of the pandemic. It was almost forced to, and it's pulling back like FedEx and UPS. Really, all the carriers are doing the same thing. Amazon is really no different. per se than any other carrier, or different than a Shopify that overbuilt its development infrastructure. Everyone made the same mistake over and over, right? So let's start with like the fundamental of Amazon, that flywheel. More sellers, more brands, more money. Has the fundamentals of Amazon's flywheel changed from you guys' perspective?
I don't think the concept, I don't think so. I think that it was never the more sellers. I think that was a misconception. It was never about the number of sellers. It was about the quality and quantity of product. And I think that they missed one of those cues, right? To me, that is the biggest gap. I think that, unfortunately, I don't know how they do it. They have to figure a way to reduce the sellers to do quality over quantity. That will bring the flywheel back. So I think right now they're seeing a lot of leakage in the areas where they were making their bread and butter was like, a certain dollar amount items. It was easy, fast. You would go to Amazon, pick it up 2 days at home. And I think they dropped the ball on the quality control part of their sellers. And so you have a lot of garbage, especially at those price points. And the more you see people are getting, forget about the mistakes around the fulfillment side, just the quality of the product is terrible, right? It's worse than buying a straight, go to the marketplaces that are hosted in China, right? You can go to, Alibaba, AliExpress, DHgate, and get the same quality for half the price. Takes a few more days to get to your house, but so I think that is one of the main things about the flywheel that Amazon is doing. And then I am really curious about, at times, if you squint, you almost think that Amazon, either purposefully or they are stumbling towards the Costco model, where the money's on the membership. They keep adding value to Prime for very good reasons, and I think that is the right play. But when you think about all the fulfillment costs, that they're going up, and sort of, how expensive and difficult
they're going to
it
have to
is
keep raising that membership cost and providing more perceived value in that membership.
They're going to have to. That is really where it comes in, right? So I find it interesting. It's funny that they have almost like a lot of their successful businesses have come from originally Prime coming to add value. Like Prime Video is a perfect example of that, right? I think Prime Video is a good product. I mean, it's not up to the levels of other publishers, but
it's good-ish.
Well, it's good enough for free when you get it free as part of your membership, right? So for a free product, I think it's pretty good. So I'm interested to see how they deal with that. I mean, I find they're moving into trying to get like luxury and fashion and beauty. It doesn't seem to me like the right fit for them. I'm curious why they're trying so hard to make it happen. But listen, I've never been I use Amazon as a consumer, had been a member for a long time, but like I've never as a DTC, mostly, marketer and operator, my view of Amazon is it's a fairly practical one. It's an overcrowded, really busy shopping mall with a ton of traffic, but I'm not really interested in paying rent at that mall. But I will happily stand at the door with a flyer about my product to capture the traffic, but I don't really want to pay rent for a store, right? So like that's how I think of Amazon as an operator of DTC business. Is like great for product introduction, great for brand awareness, but until they figure something out around quality,
try to move off to your own properties in the long run, or
and I think
control the experience more.
And I think Amazon realizes that when you look at the changes they're making, and they recently, what I never thought would actually happen is allowing advertisement to off-site properties. I never thought that would ever happen. And so that's I think it's actually underplayed in the media. I don't think nobody's talking about this, but if they truly make that change between ShopPay, or I'm not ShopPay, I'm sorry, Amazon Pay. What is it called nowadays? What is that one? It's not the wallet. Buy with Prime, whatever, that one. Between Buy with Prime and allowing advertising off-site. We talked about it, how long has it been? Several months ago, one of your LinkedIn posts, right? Where as a DTC operator, Buy with Prime has no value to me, really, unless, right, they help you drive traffic. And if that is the gate they're opening, but then that will transition the business. Then,
Yeah, I don't think they can go. They can open that door too far.
No.
Let Hendrik get his words in, because I know he has his own take on Amazon, where it is today, what changes do they need to be making?
So, Rick, I think it's important to note that I work with an agency in Oregon, Equity Commerce, and what we've seen over the last 12 months is that Amazon has essentially made 3P irrelevant and 1P vendors are back in vogue, and it's important. That's an important thing to note. Yes, they will tell you in the quarterly results that, third-party sellers are kicking them in the nuts and everything else, but the 1P vendor business is important. To Victor's point, I disagree. I think the model and the flywheel has changed. And I think the reason why it's changed is that I think internally inside Amazon, there's a belief now and a realization that their retail business is going to be growing at 4% for the next decade, and that'll be okay. I do think, though, what Victor mentioned is, and I don't think he's aware of it, but I think the flywheel moving forward will be that advertising and AWS will become the accelerators of the future. And the reason why I say that is that Amazon's advertising business has grown at a rate of knots. From a technology standpoint, it's way better than anything else that's available at the moment for the advertiser. Yes, I said the advertiser. But what people kind of forget is that amid all the chaos that's, what's called retail media networks, that's Amazon. That's nobody else. So for me, in simple terms, Amazon is the only platform that gives you end-to-end from the impression all the way to the purchase in terms of data. And if you think about it from an outsider standpoint, so Victor is a consumer, but inside Amazon's large data lake, he's another node which essentially has purchasing history. So I believe the flywheel in the future will be, we will leverage the data points that is generated inside retail to offer advertising to huge agencies which are already working with. And the movement into providing an NFL game on Black Friday, it's always to get access to brands' advertising fees, but also an opportunity for them to collect more data, which they can then use as a way to help brands create new audiences. That is, I think, what's getting lost in this entire conversation.
Hendrik, I agree with you. The only thing I would say is that Amazon already has a lot of data. I don't think they have proven an ability to leverage it well. Right? I don't know. Listen, my experience as a consumer, they already have, I've been a customer of Amazon for a decade. They have 10 years worth of my purchases and my browsing and my likes and not likes. Do you think that my experience on Amazon is conducive to an increased share of wallet or a high AOV? No, absolutely zero. I don't think I have ever clicked or bought any product that's shown in the homepage of Amazon. They have the worst merchandising in e-commerce. I'm dead serious. I mean, maybe it works for other people. As for me,
Victor,
they have never.
My point. Victor, you're making my
I just don't think that getting more data is going to fix. I mean, I agree that's the opportunity, but I don't. Right now, they could be doing that with the data sets they have, and they haven't proven an ability to do so.
One way I wanted to go with here is that Amazon has always been. You brought up a good point about quality earlier on, Victor. Amazon has always been, if you're in the marketplace, you have a product there, quality is about you serving the customer. And if you don't serve the customer, you are gone. And it could be a mistake that you're gone. Your competition could have reported you or any other, but you are gone.
It's true. Mm-hmm.
And if you didn't fulfill Amazon standards, regardless of what they were, even if they were opaque, obviously they were a lot of transparent about a lot of it. But with advertising, the world is a little bit different. Amazon doesn't always care that you buy. Amazon is determining value in the search results by, oh, well, they didn't buy, but they clicked around. And the consumer got value because they were doing discovery. They learned. How does Amazon police there was a term the other day I heard, it's like the shitification of Amazon. How does Amazon police the quality of its search results without traditional Amazon-like signals?
I think we're in the middle of that. I continue to believe that I think Amazon is a leader in the use of artificial intelligence. I know that's a buzzword, so I'm not going to say any much.
Wait. Is this Hendrik or is this Amazon's PR team on the line? Caller, can you state your name for the record?
My name is Hendrik Loopser. I'm phoning from a large country down south. But Rick, my point is that the tools that Amazon is providing advertisers and sellers have increased the access to anonymized data. And that is only happened in the last 12 months. Amazon Marketing Cloud, AMC, is a behemoth product that nobody's talking about. Why? Because it's the Switzerland of data cleaning. You can bring your entire data stack into this and then create new audiences with it. If you're a DTC business that is struggling to get traffic to it, there is an opportunity for you to do this. This is why Buy with Prime is getting all the bells and whistles from investment banks. But they haven't read your very nice, your in-depth discovery of, how the Buy with Prime experience is. My point is that Amazon has moved past being a retailer. The retail is there it fits a purpose. It's now going on to the next part of its journey, and the journey is going to be powered by software and advertising.
All right, Hendrik wins this one. Speaking of next part of the journey, a certain Canadian founder told us a year and a half ago that vertically integrated logistics was the biggest opportunity for Shopify. Now that Deliver and 6 River Robots have been divested, what's the next big idea for Shopify?
Well, I have two minds on this. I have the investor shareholder mindset behind it. I think that there's a potentially very positive development around trying to own the customer, sort of the increase of visibility and push for the Shop app, Shop Pay, sort of trying to somewhat kind of get in the middle, try to become a little bit of a marketplace. There's an interesting value there from an investor, valuation perspective. From a customer, a merchant that uses Shopify, I find that direction to be problematic and troublesome. And so from that perspective, I actually think that I am interested to see how they go about their transition supposedly to enterprise, and if they're going to really dedicate their resources to actually become a more enterprise-friendly platform that allows the level of customization and support primarily that honestly, I don't think they do that well supporting mid-level or mid-market companies.
Let me ask you one question about enterprise. If Shopify is as customizable and it's API first as any other solution on the market, and you have great support, what's preventing enterprises from adopting it?
I think that's a great question. Well, number one, right now, it's probably they have not yet. They made the news last week on this, right? But they haven't yet opened the financial side of it, right? They're still pushing really hard to use Shopify payments. They're still, if you're a subscription business, very limited in the merchant services partners you can have. And that's a big blocker for enterprise. Enterprise will never sign up for that. So I think that they have to clear that out. Outside of that, they have a struggle. They have become too used to serving smaller organizations that require less tooling. So I think that they still lack on the tooling side. They still lack on the transparency. I keep pointing this out, but you want to know if their uptime, they took that status page away a long time ago, but they haven't brought it up. I don't know that any enterprise technology team will be okay not knowing when their servers were up or not, right? And so I think that there's a cultural thing they have to overcome to really become enterprise. But no, they have the right. I think they have the right base. They just need to change their mindset slightly, and sort of maybe leave the rebels behind a little bit, because there's not a never-ending stream of rebels. Let's say that, and I think that they're starting to reach that point, and maybe they need to focus on those that made it beyond rebels and actually built an army and have a real business. And I think that they left that cohort a little behind over time.
Hendrik, I know you have a lot of thoughts on Shopify. What's next from them from your point of view?
So I'm going to firstly state that I have I work with companies that use Shopify, but I don't pay the bills. So I think I can have a bit more clear view on this. So number one, Rick, you asked about what's their future and what's the immediate future. I think it's already been shown to us. It's called the checkout as well as payments. They, for me, in simple terms, are going after PayPal's business in trying to create scale through payments. And to that point, I think the question now becomes, if you're a commerce business, first, is it easy adding payments? Or if you're a payments company, is it adding the commerce elements to ensure that you have a sustainable business? Let's be very clear here. Victor dodged the question but I understand why he
dodged the question.
Yes. The question was, for me, why are enterprises not going to Shopify? I'll tell you why. It's switch costs. And also, let's be bluntly honest, if Victor feels that mid-tier businesses aren't being properly solved, are you really telling me an enterprise customer that's doing over $1 billion in revenue wants to be worried about whether their business is up and running? So they have lots to do.
I think, right? Just because I think that what enterprise needs from Shopify is a little more like a sense that the organization is aligned in the area of focus being that. It doesn't feel that way, right? You have, until recently, right? They're like, we're going to do fulfillment. Who's going to go do fulfillment with Shopify, right? Please. They're doing payments. But they do payments as a white label of Stripe. That's not serious, right? Who's going to do that? And so they're trying to do this shop app. I think enterprise loves that. It's a distraction. They're not focused on the things that will drive revenue and success for enterprise. They do some good things, but they need to show attention to that, right? And they have been over-reliant on the app ecosystem. I know you and I disagree on this. You see it as a huge moat. I see it as I don't see it the same. I think that, and they're not picking winners. That's an interesting thing to do. So now they're undermining their own app ecosystem by picking winners for different pieces. So
I think there's a very different thing from a Shopify app ecosystem that is good for entrepreneurs than the one that's good for enterprise. That I 100% agree with, because I think the caliber of the apps needs to be greatly improved. I think the caliber of the implementers in the integration needs to be greatly improved, as well as the support provided to the merchants to find these providers, to work with these people long-term. Because, look, the biggest challenge that Shopify is going to have in this market is that there is no way Shopify is going to let go of being the entrepreneurship company. It's not possible. And so to the extent that it's not possible, it just means that you add more doubt to the enterprise sales process. And I think that's the challenge that they're going to have. So with that, I'm going to wrap up the show for today. I appreciate Hendrik and Victor, you guys coming on. It feels like we could have spent an hour on each one of these topics.
Yeah.
And we're just scratching the surface of a lot of these topics in e-commerce. But it also gives you some idea why these interview podcasts are so long. Why does Joe Rogan have a 3-hour podcast? Because he gets to all his questions, or somebody like this. So anyway, the Watson Weekly, we're not going to be that. Every now and then we're going to have guests on, and we'll do it that way. So any last words, Victor?
Oh, thank you for having us. Congratulations. Big milestone. Keep it up.
All right. Thanks a lot, guys. I appreciate your time.
Cheers, Rick. Thanks for having us.